Hello, and welcome to the USDA's Basic Training on Loan Servicing Loss Mitigation. This module is designed to help you better understand the requirements outlined in Chapter 18 of the Handbook 1-3555. A goal of the agency is to provide a borrower the maximum opportunity to become a successful homeowner, and the servicer should approach loan servicing as a preventative as well as a curative action. Prompt counseling and follow-up with a borrower who is late with a monthly payment, especially the first payment, is key to enhancing the likelihood of success. The servicer should identify any servicing actions that could aid a borrower who is experiencing repayment problems. When a borrower's account becomes past due, the servicer must, at a minimum, take the collection efforts described in the next slide. Each delinquency should be treated individually using collection techniques that fit the individual circumstances. Additionally, the agency recommends making personal contact with the delinquent borrower until the delinquency is cured. Debt collection efforts should be suspended when applicable laws restrict creditor action to collect a debt or take action, such as when the borrower files bankruptcy. The 5 servicing steps are: 1. Attempt to make initial verbal or written contact on or before an account becomes 20 days past due. Servicer must attempt to find out enough information to evaluate the borrower's ability to cure the default and to determine if additional servicing actions are needed. 2. Notify credit repository. Servicer must provide accurate and complete status for all USDA loans to a minimum of 3 credit repositories each month. The goal is to avoid disputes arising from inaccurate or inconsistent reporting. 3. Send a certified letter to the borrower before the account is 60 days past due. If a payment arrangement is not already in place, the letter should request an interview in an attempt to resolve the delinquency. 4. Inspect the property on or before the 60th day of delinquency and before initiating a liquidation action. This is needed so the servicer may assess the physical condition of the property, determine occupancy, and take needed steps to preserve and protect the security property. 5. Proceed with liquidation once the account becomes 90 days past due. These steps are taken if the borrower has been unresponsive or has declined all available foreclosure prevention options. The servicer must consider any applicable notice requirements and waiting period under state law. Whenever possible, the servicer should review the borrower for all loss mitigation options concurrently and, if eligible, provide a decision based on the highest available option in the waterfall. In all cases, if a borrower is eligible for both a retention and a pre-foreclosure option, the retention option must be prioritized. If the borrower accepts and then fails a retention option within the first 12 months, they can be offered a pre-foreclosure option based on this evaluation with no further need to document ability or inability to pay. The details of each action are found in Handbook 1-3555, Attachment 18A, Loss Mitigation Guide. An informal repayment plan is a verbal agreement lasting for 3 months or less. Such a plan is the first and best means to ensure that a 1 or 2 month delinquency does not escalate beyond the borrower's ability to cure. In such a plan, the servicer should carefully review the borrower's financial situation and arrange payment terms that the borrower can realistically keep and the delinquency can be cured. Informal repayment plans should be documented. However, there is no requirement to report such plans to the agency. When the loan is a minimum of 30 days delinquent, servicers may use a special forbearance to help the borrower become successful. This is a written agreement that may temporarily reduce or suspend and/or gradually increase monthly payments in the amount sufficient to repay the arrearage for a short period of time. The maximum arrearage under a special forbearance plan cannot exceed the equivalent of 12 months delinquency. A loan modification is a permanent change in one or more of the terms of a loan that results in a payment the borrower can afford and allows the loan to be brought current. To modify a defaulted note under loss mitigation, the loan must not be in foreclosure at the time the modification is executed. However, a loan removed from foreclosure status may be modified. The default is due to a verified loss of income or increase in expenses. The servicer may, at its discretion, modify a loan that is not delinquent but is in imminent danger of default, i.e., will soon become delinquent due to known circumstances. For a loan to be modified, both the property and the borrower must be eligible. Property eligibility. The servicer must conduct an inspection to verify that the property has no physical conditions that adversely affect either the borrower's continued use or ability to support the debt. Normally, a simple curbside inspection is sufficient. However, a borrower will not be able to support payments under a special forbearance plan if the property is in such deteriorated condition that repairs will exhaust the borrower's monthly resources. Borrower eligibility. Current borrowers must be the same on the modified mortgage. Borrower must continue to occupy the property as primary residence and must be in default or facing imminent default. Servicers may collect financial information from borrowers either in writing or during a telephone interview. Regardless of how the borrower's financial information was collected, the servicer must independently verify the financial information. Using this information, the servicer determines if the borrower has the capacity to support the modified monthly payments and bring the loan current under the terms of a forbearance. The proposed repayment terms must be consistent with the borrower's ability to pay. The following documentation must be obtained to determine financial capacity of the borrower: a letter from the borrower outlining involuntary inability to pay, hardship, income documentation as stated in the overview section, credit report. This credit report should only be used to validate monthly installment debt, revolving debt, and secondary mortgage debt. If a borrower's credit score is obtained from the credit repository, the score will not be considered in determining whether a borrower is eligible for loss mitigation. A detailed budget and documentation of any other sources of income to be used in the evaluation. Stipulations that apply to all loan modifications. The modification results in a fixed rate, fully amortized loan. The modified interest rate may be higher than the original rate but cannot exceed the current market interest rate at the time of approval, and the modification brings the loan current. The servicer shall calculate the target payment as 31% of the verified gross monthly income. Loan modification options shall be used in the following order to bring the borrower's mortgage payment, PITI, to as close as possible to the target payment. Options under a traditional modification to reach the target PITI payment are: 1. Capitalize all delinquency. Capitalization may include not only past due payments, but also foreclosure fees and foreclosure action costs incurred by the servicer, any deficits in tax and insurance escrow accounts, and past due annual fees imposed by the servicer. Also, any past due homeowners association dues should be capitalized if necessary to protect the first lien position. However, servicer late charges and fees cannot be capitalized. 2. Modify interest rate to a level at or below the maximum allowable rate as defined by the agency. If the maximum allowable interest rate has not been established by the agency, the servicer should use the most recent Freddie Mac Weekly Primary Mortgage Market Survey, PMMS, rate for 30-year fixed-rate mortgages plus 50 basis points rounded to the nearest 1/8 of 1%, 0.125%. If the target payment is unable to be achieved with rate reduction alone, the servicer shall extend the term in 1-month increments up to a maximum of 480 months until one of the following is achieved: the mortgage payment is at or below the target and the payment has been reduced a minimum of 10%, or the mortgage payment is at or below the target and the term has been extended to the cap of 480 months. If the target payment is still not able to be achieved, the servicer may consider a mortgage recovery advance, MRA, in addition to the rate and term modification. The maximum amount of MRA available for the borrower is 30% of the unpaid principal balance of the mortgage at the time of the original default, minus any outstanding MRAs previously provided to the borrower. For modifications utilizing an MRA, a 3-month trial for if imminent default is required to be completed prior to executing a final modification. More information on MRAs will be provided on the next few slides. If all modification options have been considered and the target payment cannot be achieved, but the PITI payment has been reduced by at least 10%, the servicer should offer the modification to the borrower. If it is determined the borrower cannot be provided with a payment reduction and no other options are available, a modification can still be offered, including a limited increase in payment. The following conditions must be met. The borrower's post-modified payment is no greater than 36% of their monthly income. The borrower's post-modified payment has increased no more than 10%. The modified principal balance may exceed the loan's original principal balance. The modified principal balance may exceed 100% loan to value. The use of a trial payment to support the borrower's willingness and ability to pay is encouraged for a modification. However, it is not required unless an MRA is utilized as part of the modification or there is an increase to the borrower's payment. Mortgage Recovery Advance, MRA, are funds advanced by the servicer on behalf of a borrower to satisfy the borrower's arrearage, pay legal fees, and foreclosure costs related to a foreclosure action, and reduce the principal. The maximum amount of a mortgage recovery advance is 30% of the unpaid principal balance at the time of the initial default, which includes any principal reduction needed to achieve the target monthly mortgage payment. The servicer should advance funds to the borrower's account by creating a non-interest-bearing recoverable servicing advance as a receivable on the borrower's behalf. This amount should remain a part of the borrower's loan file and be stated as an outstanding balance on the monthly mortgage statement along with the principal balance. The borrower should sign an agreement with the servicer to repay the entire outstanding MRA balance when the guaranteed first lien matures or pays off. MRAs made after April 14, 2025 will remain a part of the servicer's first lien and will not be secured with a note mortgage in favor of the agency. MRAs executed prior will be referred to as legacy MRAs. To file a claim for reimbursement of an MRA, the servicer must submit a claim to RD within 60 days of the advance being executed by the borrower through their signature on the MRA agreement. When filing the claim for reimbursement with RD, the servicer must submit the borrower's agreement to repay the funds. The servicer must also submit a summary of the amount of the funds advanced, including the monthly PITI and principal deferment, if applicable, and other account information indicating the borrower's arrearage before the advance. In addition, the servicer should supply the present status of the account as of the date of the advance, including evidence the loan has been reinstated, the name, address, and tax ID number for the servicer, and the name, address, and phone number of a contact person for the servicer who can answer questions about the reimbursement request. The documents should be uploaded through the USDA link website. The complete package must be submitted within 60 days of the execution of the mortgage recovery advance. No interest will accrue on the mortgage recovery advance. The payment of the mortgage recovery advance is not due until the earliest of 1. The maturity of the modified mortgage, 2. The borrower transfers title to the property by sale or by other voluntary or involuntary means, or 3. A payoff of the mortgage. Borrowers are not required to make any monthly or periodic payments on the MRA. However, borrowers may voluntarily submit partial payments without incurring any prepayment penalties. Any repayment by the borrower of the MRA, whether partial or incomplete, must be remitted back to the agency from the servicer prior to release of the lien. If the servicer determines the borrower is not eligible for a modification, the servicer can offer the borrower a standalone MRA to cure the delinquency and return the borrower to current status if the following criteria is met. The hardship that caused the borrower's involuntary inability to pay has been cured. There is no reasonable ability for the borrower to cure the delinquency on their own within 12 months. In addition to the standard workout options listed in Attachment 18A that we already covered, when a presidentially declared disaster occurs, servicers should take steps to protect and preserve collateral properties. They may also consider special relief measures for borrowers who live or work in presidential declared disaster areas to help borrowers continue to be successful homeowners. The servicer must suspend all foreclosure actions for affected borrowers in presidential declared disaster (PDD) areas effective for 90 days from the date of declaration unless extended by the agency. This applies to both the initiation of new foreclosures as well as foreclosures already in process. When a borrower is eligible, borrower eligibility includes Borrower lives in home as primary residence. Payments are current or less than 30 days delinquent on the date the PDD was declared. Servicer receives verification the hardship has been resolved, and modified PITI is less than the original PITI, then one of the following options may be considered: payment deferral, capitalization of delinquency, and term extension, or mortgage recovery advance, MRA. If the servicer determines the borrower can maintain the current contractual payment, including any escrow shortage created by advances during the forbearance period spread over 60 months, the missed payments may be deferred to the end of the loan term. The term must be extended along with the deferral, thus allowing the borrower to make regular payments until the deferred balance is paid in full. Any interest accrued during the forbearance period should be included in the deferred balance. If the servicer determines the borrower can maintain the current contractual payment but not manage the additional escrow repayment amount, the servicer may offer a cap and extend modification under the following terms: capitalize the accumulated arrearages and eligible unreimbursed servicer advances, fees, and costs into the modified mortgage balance. Extend term for a total of up to 360 months. Modify the interest rate to no more than 50 basis points greater than the most recent Freddie Mac Weekly Primary Mortgage Market Survey, PMMS, rate for 30-year fixed rate conforming mortgages, U.S. average, rounded to the nearest 1/8 of 1%, 0.125%, as of the date a plan is offered to the borrower. The servicer may utilize an MRA to settle the borrower delinquency and bring the borrower current. The MRA is limited to an amount no greater than what is necessary to resolve any accumulated delinquency and cannot exceed 30% of the unpaid principal balance. Reminder, if the borrower has previously been provided an MRA under special relief measures due to a natural disaster, they may be considered for an additional MRA provided that the combined amount of MRA does not exceed the 30% as outlined above. When a delinquent account cannot be salvaged through the servicing options already discussed, the borrower may sell the property even if the proceeds are less than the amount owed. This may be accomplished through a pre-foreclosure sale discussed on the next slide. When that is not successful, the servicer may consider a deed in lieu of foreclosure to liquidate the account. Both of these actions are considered voluntary liquidation. The borrower requests this of the servicer and submits the required financial information. Together with an appraisal and preliminary title report ordered by the servicer determines feasibility of the sale. The borrower commits to actively market the property for at least 3 months, and foreclosure action ceases during this time. If the property does not sell, a deed in lieu should be considered. This is when the borrower voluntarily deeds the collateral property to the servicer in exchange for a release of liability of all obligations under the mortgage. This can only be done prior to a pre-foreclosure sale in case of death, borrower incapacitation, or other extreme circumstances. The servicer uses good business judgment when determining feasibility and retains all appropriate documentation in the case file. A non-occupant borrower may be considered if it is determined the vacancy was involuntary in nature, such as job loss, mandatory transfer, divorce, death, etc. Property should not be considered if the cost of repair exceeds 10% of the as-repaired appraised value or poses an environmental or health risk. If the cost to repair the subject property exceeds 10%, agency concurrence is required. For a pre-foreclosure sale, the borrower requests this of the servicer and submits the required financial information. Together with an appraisal and preliminary title report ordered by the servicer determines feasibility of the sale. The borrower commits to actively market the property for at least 3 months, and foreclosure action ceases during this time. There are certain eligibility criteria that need to be met for a pre-foreclosure sale to be considered by the servicer. 1, loan eligibility. The loan is in default more than 30 days or imminent default. Delinquent more than 30 days at the time the pre-foreclosure sale is closed. 2, borrower eligibility. The borrower is in default or facing imminent default due to a verified increase in living expenses or decrease in income, occupies the property as a primary residence, and is not eligible for any available retention options. And 3, property eligibility. A servicer-obtained appraisal should demonstrate there are not necessary repairs exceeding 10% of the value. If the property does not sell, a deed in lieu should be considered. This is when the borrower voluntarily deeds the collateral property to the servicer in exchange for a release of liability of all obligations under the mortgage. This can only be done prior to a pre-foreclosure sale in the case of death, borrower incapacitation, or other extreme circumstances. The servicer uses good business judgment when determining feasibility and retains all appropriate documentation in the case file. Before accepting the deed conveying the property, the servicer should document that the loan is in default, delinquent more than 30 days, and the cause of the default is incurable. A non-occupant borrower may be considered if it is determined the vacancy was involuntary in nature, such as a job loss, mandatory transfer, divorce, death, etc. Property should not be considered if the cost of repair exceeds 10% of the as-repaired appraised value or poses an environmental or health risk. If the cost to repair the subject property exceeds 10%, agency concurrence is required. When a servicer determines that a borrower is unwilling or unable to meet their loan obligations and there is no reasonable prospect of resolving the delinquency through loss mitigation, servicers may consider a streamlined final offer prior to initiating liquidation proceedings. This solicitation should run concurrently with the acceleration, and any action should only be paused once the borrower provides a trial payment. If the loan meets all of the following criteria, the servicer may send a final alternative to foreclosure offer with no documentation required from the borrower. The loan must be greater than 90 days delinquent. The unpaid principal balance, or UPB, is no less than $5,000. The borrower has made at least 12 mortgage payments since origination. The property is not vacant or abandoned, and the borrower is not currently in loss mitigation. The lender should continue to meet all foreclosure obligations and timelines during this solicitation. If the borrower responds with the initial trial payment, the servicer may place the foreclosure on hold. The terms of the streamlined option shall be as follows. The interest rate may be modified. The loan repayment period may be extended in 1-month increments to the maximum term allowable, not to exceed 480 months. The terms below must result in a reduction of the borrower's principal and interest payment by at least 10%. The borrower must demonstrate a willingness and ability to pay by making 3 consecutive trial payments, all of which must be made in the month they are due. Once the trial is complete, the borrower must execute a final modification agreement within 60 days of the last trial payment that includes a hardship affidavit attesting that they occupy the property as a principal residence and have suffered a financial hardship that created an involuntary inability to afford the current mortgage payment. This agreement can be sent after 2 trial payments are received. Any streamlined option made to the borrower shall have a 30-day expiration date. If the borrower fails to respond prior to the expiration of the solicitation, the servicer may, at its discretion, extend that offer an additional 30 days. If the borrower fails to respond with an initial trial payment or otherwise fails the trial, the borrower shall be ineligible for any future final offer under this section. This concludes our module on servicing loss mitigation. We appreciate your attention during today's presentation. Questions should be directed to the Loan Servicing Branch at SFHGLP@USDA.gov.